Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
I'm looking at that oil deal, Diamondback buying Endeavor. You have FANG stock, which is Diamondback stock. It is up by 10%.
Nice.
Wow, that is a really nice move. Vince Piazza is Bloomberg Intelligence Senior Energy Research Analyst, and he joins us now. Vince, do you like the deal?
I think the deal ticks all the boxes that we're going to need to see in this M&A wave in the Permian. It grows Diamondback's acreage. It grows locations, so inventory is not going to be an issue. In terms of the price that they paid, look, Diamondback in my universe of coverage was the highest, had the highest premium. So they're using their multiple to get this deal done. And so elevated currency, along with some cash and debt, they do have a fairly low leverage on their balance sheet. So yeah. I think this ticks all of the boxes. They'll throw off significant free cash flow in 2024 and 2025. So in terms of paying off whatever bank loans that they're going to take on for this, I think it works out extremely well. And you're seeing the response by the investors in the marketplace. It also works out for the founding family of Endeavor. They get to monetize decades of hard work. So,
hey Vince, I have a question though with that. I mentioned that this was a merger of equals, and I got kind of laughed at. Like, there's no merger of equals when it comes to M&A. But in this case, like, is there though?
Well, in this case, think about what Endeavor brings to the table. It almost doubles Diamondback's Midland acreage, and it brings sizable oil production for the broader Diamondback franchise. So I would tell you that in terms of size, it is a merger of equals, but the family will get roughly 30% of Diamondback, with selling off almost half the resource to Diamondback. So it basically doubles Diamondback's total size. And the founding family gets about 30% of the new Diamondback, let's say.
Vince, are there any regulatory issues here? A lot of M&A going on in this space here.
Yeah, it's going to get looked at. So Southwestern and Chesapeake getting together out in Appalachia, that's a gas deal. But that'll get a very, very clear look, a very, very deep look by the regulators. This will as well. I don't see why it wouldn't. Because of the actual size of this entity. It's going to be an enterprise value of north of $60 billion. It will be the largest Permian pure play. So it'll get looked at. All these deals will get looked at, and it'll take a deeper look, same as Southwestern and Chesapeake.
I was talking to Jen Reed this morning. She covers antitrust for Bloomberg Intelligence, and she's like, yes, like all of these are going to have to get looked at. They're particularly interested in the Exxon Permian Pioneer deal, and that all these deals are definitely going to have the FTC sort of wide-eyed looking at it. But you have to wonder, though, if they want more oil, they're going to have to do it, right, Vince? I mean, I'm just trying to think of like what the rationale will be to block, say, this deal, but like let Exxon and Pioneer go through. Like you can't.
This deal is much more North America centric, much more North America focused. So when you think about, Exxon and Pioneer fits within Exxon's Permian portfolio, but Exxon is a large integrated multinational franchise. This is more U.S. centric and Permian centric as well. But look, they're all going to get looked at. It is what it is. This is a very large transaction. Like I said, Southwestern and Chesapeake is getting looked at. This will get looked at as well. It's an important resource. What you have here, though, is you have resources now in stronger hands. You have ExxonMobil, Chevron, you have Diamondback, you have very large entities with big balance sheets and the capability to take down even greater levels of capital in order to move production from the delineation phase into the production phase.
So give me a sense, Vince, I'm putting my banker hat on. Can I keep doing a bunch of deals here? I mean, how many players are left?
Yeah, it's a very interesting question. So we put out last year the top 20 privately held PE-sponsored names in the Permian. In this case, Endeavor being the second largest. Mewbourne, which has mentioned that it wishes to sell. That's the largest of the top 20. That'll go out, we think, because it has been mentioned as a takeover candidate. Similar situation, founding family looking to move the assets. If you think about the top 5, 3 are now gone. So there is a great deal of interest. There's interest by the private players as well, especially the PE-sponsored players. You're getting close to these vintages that are aged, and now this capital needs to be recycled. So you will see more of that. You will see public buying private. Public does have the currency. In the case of Diamondback, they had a premium multiple, elevated currency that they were able to use to monetize the founding family's investment. And you'll see that as well, especially in the Permian, where you do have this difference of large cap premium valuations looking for assets and the smaller cap names trading at a relative discount to peers, but trading at a discount to the larger names as well.
Well, that's really the thing, private equity being like, oh, thank God. We can kind of get these things out. So Vince, what I also found interesting, I was reading through some of your research on this just to get more background on some of the private players, is just how much these private guys have been responsible for a bulk of the drilling. And in some ways it makes sense, right? Shareholders want the big guys to be capital disciplined. They're public. They got to report. So therefore they have to be capital disciplined. But a private guy doesn't have to do that. They can do whatever they want. Walk me through the importance, though, of these guys within the shale development.
Yeah, so we tend to think that the private players have been responsible for at least half of the production growth in the last few years. Wow. What we have seen is these privately sponsored players putting out that production growth to entice the public players to buy that asset. And what the public players tend to do once they integrate that asset is to slow that production growth down, remove the rigs from that private player, and generate cash flow. This enhances free cash flow and allows the public player to pay down that debt, to push out payouts, dividends, or stock buybacks to the investors for rewarding them sticking around post the deal. So that's what we've seen. Production growth by the private guys. Public guys come on in, buy the asset, turn down the volume, ratchet down the speed, generate that free cash flow so that the balance sheet, so that the income statement looks stronger post the deal. And it's been working for the last couple of years. And that's why you see such a great reaction in the aftermarket when these deals are announced, especially this deal. And also, if you take a look at some of the gas deals that have been done as well.
Hey, Vince, as an investor, do I care about where the rock is located? Is Pennsylvania shale better than Texas shale? How's that all work?
Yes. Whoa.
Whoa.
Yes. Yeah, you care?
You care?
Whoa.
Tell me.
Yes, you care. You care because when you're selling a commodity, concentration drives synergies, efficiency, and productivity. But especially so in places like a legacy play like the Permian, or in places like Appalachia or in the Haynesville. Interestingly, these last few deals that we've seen in those plays, those prominent legacy plays, those proven plays where you have a lot of runway and you can buy these assets, integrate them, grow that concentration, and generate those efficiencies, generate that productivity going forward.
Who's next? Who's the next buyer?
You know what? I will tease the audience. Go on to the terminal, look up our research. We put out a piece highlighting the 20 private sponsored E&Ps in the Permian. We go through that list. Mewbourne has been mentioned, so we can throw that name out there. But there are plenty of names in that top 20 list that seem to be putting themselves in a position where some type of capital event could be announced.
Hey, Vince, great stuff. Really appreciate it. Deep tease there, everybody. Check out Vincent's research on the Bloomberg Intelligence on the terminal. He's Bloomberg Intelligence Senior Energy Research Analyst. You have to wonder, though, how many buyers they're going to be.
Right.
And who...
So rock is not rock?
Rock is not rock. Well, rock is rock, but some rock is better than other rock.
Some rock is better than other rock.
Definitely.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
A great game. Big platform for advertisers. Arguably the biggest day of the year for the advertisers. The question is, do these things even work? I mean, is it worth it? Is it worth $7 million plus whatever your production is?
I was not impressed.
I don't know. I thought some good ones, some ads were good. I like the Dunkin' Donuts, but there's some people who actually measure this as a business. They don't just watch it; they measure it as a business. Our next guest, Kevin Krim. He's the CEO of Entertainment Data Oracle. Kids call it EDO. He joins us live here in our Bloomberg Interactive Broker Studio. He knows his way here. He's been in Bloomberg before. Kevin, thanks so much for joining us here. We really appreciate coming in. I thought there was some pretty cool ads. From your perspective, what are brands trying to do here at the Super Bowl, and how do they measure if it even worked or was successful? How do you think about it?
When marketers are thinking about what they're trying to achieve in any marketing, but especially on television, which is at the top of the pyramid of value in advertising, at the very pinnacle of that peak is the NFL, and the Super Bowl is at the absolute top. When we've measured 9 Super Bowls now, and what we're measuring is the consumer engagement with the brands or products being advertised. And any marketer's trying to achieve awareness and then engagement with their brands. And we're measuring engagement as searches and branded website visits, app usage, the kind of digital behaviors that are predictive of sales lift, but they're immediate and they're easy to collect large amounts of high quality data.
What's the time frame for that? Is it like right after the ad airs? Is it in the next 24 hours?
Most of that engagement happens within minutes of the ad airing, but because of streaming, because of the ability to DVR or TiVo it, you do have a tail to that, and we'll see activity for a week or more after a big ad airing like the Super Bowl. And when we see what kind of engagement is driven relative to what else you can get on TV, like let's say an average 30-second spot on primetime broadcast or cable, the Super Bowl does many multiples of that. We're talking the average advertiser would have to buy hundreds of those 30-second spots on regular primetime to get the same impact as a single airing on the Super Bowl. Wow. So on a dollars basis, we find that the Super Bowl is a very good rational decision for most marketers, but then the pressure's on the creative, and the creative has to be strong or you're not getting your money's worth. And that's where, we saw ads yesterday. Some of them were fantastic. Others, I think, played it too safe. And you're going to see quite a range in how much engagement is driven from those ads.
So from your perspective, maybe from the data's perspective, a winner or two, which one did you jump out at you?
Let's talk about real quick the top 5. Number 1 was Deadpool 3. Number 2 was...
I have thoughts on that because I'm a huge Deadpool person.
There you go.
Love it. But then again, he could come on, Ryan Reynolds could come on and say hello, and I'd be like, that was brilliant. That was amazing.
It was a fun spot. And the tease of having Wolverine joining him is very satisfying for any Marvel fan. Number 2 is the film adaptation of Wicked. Another interesting teaser, Ariana Grande in one of the starring roles there. So that's going to pick up a lot of attention. And then number 3 was the Volkswagen ad that kind of harkened back to their heritage of bringing the Beetle to America. And then it teased their new all-electric bus. So the VW bus returning to America after a long gap. Number 4 was Temu. Or Temu, as we all learned was how to pronounce it yesterday. They ran 6 spots between pregame, in-game, and post-game. 6 spots. That's a huge investment. Yep. But this is an interesting one. A lot of people's opinion of that kind of spot would say that it was one of the worst. And
actually, that doesn't even resonate with me. What is the
Temu
company
is
do?
it's a mobile shopping app.
Okay.
And they started their first real kind of advertising in the U.S. was last year's Super Bowl.
Okay.
That kicked it off. They were one of the most downloaded apps in the Google App Store and the Apple App Store all of last year. They followed it up with a bigger bet this year, and it is
because the discounts are insanity. Like if you go on there.
Yeah.
I mean, you have to measure, like, what am I actually buying? Like, there's that conversation we have, but the number price, it's unreal. And there's, like, extra deals. Like, it's huge.
Temu and Shine, or Sheen, I'm not sure how to pronounce it properly, are both China-based apps that are about these giant discounts and are very popular, apparently, with bargain discount shoppers.
How about booze?
We saw, really interesting, we saw no liquor ads this year. We saw a smaller number of beer ads than last year. What we did see was some top performers were soda ads, and we had Poppy in our top 5. Poppy's this new...
Oh, yes. We're Poppy fans.
Premium priced. Would you call it like kind of like more popularized kombucha is maybe the way to...
Without the fermentation. Like,
Right.
I'll give Poppy to my daughter, but she can't have kombucha.
Right, because there's trace amounts of alcohol in the kombucha. Yeah, so it's
exactly
got
how I was thinking about
probiotics,
it.
low sugar, supposed to be good for you, and it's $2 a can.
Yeah. Oh.
So the margins are incredible. It's an independent soda company from Austin, Texas, husband and wife founders, and they made a big statement.
Austin, Texas,
popping into the top 5. That's going to lead to a big lift in their sales. I mean, we can say that with total confidence. Whether that sticks or not is, Alix is saying it's good. So they may have a shot at being a top soda brand.
Not bad.
Okay. How about nostalgia? In the nostalgia-driven TV reunions,
A lot of reunions. I would say they were a mixed bag in terms of performance. I loved most of those spots. I mean, the Duncan spot was in our top 20. That was probably the best performing of the nostalgia-based ads. We saw Jennifer Aniston and David Schwimmer reunite in the Uber Eats
weird.
ad.
Did you like that one?
I thought that was a fun moment.
Yeah.
It was a fun moment.
Okay.
But again, and to the other top performing spot, we had the Parks and Rec, several of the leads in Parks and Rec in the ad for Mountain Dew's Baja Blast soda, and that was a lot of fun.
Interesting. And we had to, I like what you put in your notes here that streaming is the new syndication.
Yeah.
That's where shows go to live.
That's right.
Forever. And one of the examples, and then maybe become popular again, one of which is Suits. Which is all over my social media feed, and I never even paid attention to it when it was on whatever network it was years ago.
Right.
But they're making a huge comeback.
Right. So that was NBC Universal originally. I think it was USA Network when in its first run. The top streaming series on Netflix for last year, and you saw the Suits stars and a bunch of other stars from a bunch of the series that were hot maybe 15, 20 some years ago and are now top streaming series in their sort of rerun stage on whether it's Peacock or Netflix or others.
What else stood out to you? What was like a wow factor?
Yeah, I mean, I would say besides those things that we talked about, I would say the automotive category was really interesting. All the ads outperformed the average. They were all import or foreign automakers. They were not any of the big 3 from Detroit, which is very unusual.
So why do you think that was? Was that did you hear anything coming out of Detroit saying, hey, we're just...
I didn't talk directly to all of them. Some of them are my clients. I'll be discreet. But I would say what I heard loud and clear from the industry overall, you've got to have the right product to launch. You don't want to have a disrupted supply chain when you're doing a big Super Bowl ad. It usually is best to use a Super Bowl as the start of a big campaign. So to launch a new model is key. And then, yes, if you're coming off of bruising, negotiations with your unions, probably one of the better things to do is maybe just sit it out,
That's a good point.
wait till next year.
Well, what's their messaging? It's like, hey guys, these EVs, we're still making them. You should buy one, but we're also going to do these ICEs, and these are really cool. Go buy those. Like it's like we're going to do all that money over there. I mean, it's a pretty tricky line.
It's a tough balancing act. So to sit on the sidelines for this year, smart move.
Were you surprised that we didn't see any price inflation this year from last year? $7 million for a 30-second spot. Usually we've seen, mid-single, high single-digit inflation year to year.
I think it's a challenging market as we shift from traditional to streaming. But I would say anyone who bought an ad from CBS this year
Yep.
got a fantastic deal, right? I mean, you know, the Super Bowl always performs consistently, but on top of that, you had the Taylor Swift effect.
Yep.
And you can't plan on her team being
Right.
in the Super Bowl. That's a bit much. But just if you were sitting there last September as the season got started and you made a commitment
Yep.
to $7 million, you had a good hunch that this would be a sustainable positive
Right.
effect, a tailwind, if you will, for the whole sport
Yep.
with Taylor involved.
All right, good stuff. Kevin Krim, thank you so much for joining us. Kevin Krim, he's the CEO of Entertainment Data Oracle, EDO, joining us live here in our Bloomberg Interactive Broker Studio.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
So S&P 500, like you were saying, right, 5028. But I take a look at the strategists' call for this year. The average is 4867. The median 4950. The high 5200. The low 4200. So it's like either a lot of people are wrong, we're going to see a lot of upgrades, or we're just going to have a crash out at some point,
Right.
which is quite interesting. So
And at the end of the day, it's all about making money. So you do the earnings analysis on the S&P 500, and the earnings surprises so far this quarter of those companies that have reported is something like 80% at this point. So it's impressive.
Yeah, you can make the argument that it's legit and then it's actually broadening out to a certain extent. Let's ask Kim Forrest. She is founder and CIO of Bokeh Capital Partners. Hey, Kim, I take a look at the strategist notes then for this year, where we're trading at right now. Is this a crash up, a melt up? Does it continue? Or is it fundamental here at this point?
Well, I have to say, I think people by and large are kind of terrible at forecasting, as we saw last year. And maybe this is more of the same, right? And I think it's going to be a crash up, I have to say, because the markers of slowdown or more than slowdown are just not there, right? So, and we'll see tomorrow, and this is a data-rich week where we have more earnings, but probably most importantly, CPI, and then retail sales to see if the consumer continues to spend. But we believe they do. So why not end the year above 5,000? I think that's a good call at this point.
Why not own the Magnificent Seven? Why not keep buying them today? Is this AI thing real? You've got a perspective here, don't you?
I think the AI thing is real. I have to disclose this. I was a software engineer working in AI before I moved on over to the world of finance as a sell-side equity analyst.
I didn't know that.
And
No
so I know of which I speak.
So, Kim, but
It is for real, but it's never going to play out the way investors think at the beginning of a rush, right? They think NVIDIA and Google and Amazon and all the rest of the Magnificent Seven are probably going to be winners. I think they are going to win, but there's going to be other more nuanced AI applications that come in, and it might be the killer app.
I mean, I'm looking at NVIDIA here, up 48% year to date, 250% trailing 12-month basis. NVIDIA overtakes Amazon in market value. Bloomberg News just crossed the tape here. Do I just keep buying these chips? Are chips the way to play this?
I think chips are, but I don't know that NVIDIA is our final winner. If you notice, there's a theme in chip land, and that is to make chips that are as good as NVIDIA, but maybe not cost as much. Even Sam Altman, although he's kind of a dreamer, that's the ChatGPT guy. He's really going all in on trying to design his own chips and getting people, interested in funding this new company. But I think that chips are a way to go, and it's going to allow for a more, as I say, nuanced approach. You know that we're going to have to collect data, and chips are the way they do that to put into these models. So I think chips, by and large, are a winner here as a sector.
So Kim, for individual names then, how do you play it if it's not going to be NVIDIA?
Sure. Well, I mean, I think NVIDIA wins, but does it continue to double, quadruple? I don't know.
Sure.
I'm thinking no. So the next two closest competitors that may have a product that can help people build these large AI models at a lower price are both AMD and Intel. Now, they've been known for PC chips, and that's been dragging them down. But let's give them credit for coming up the curve and serving this market. I think that they have a good shot to do that.
Kim, we're about a little more than 60% of the way through the S&P 500 reporting earnings. Any themes for you, either plus or minus, coming out so far?
Sure. I think the smaller companies are looking more interesting to me because of mergers and acquisition potential. Mergers and acquisition completely dried up in 22 leaving 22 into 23, and it's largely because we were in a rate hike cycle by the Fed. And now that we seem to have reached peak interest rate, maybe that is what is bringing people back into M&A. And I think looking for high quality companies in niche markets is another way to go.
So this wouldn't be like a buy the Russell here at this point, would it?
No, not at all. There's a whole lot in the Russell. Look for those companies that have product management, that are creating and delighting their customers, and that might go well with a larger company that needs that niche product.
But buying takeout targets, that's tough, isn't it? I mean, that's a tough one.
It is, but it's exciting. It's
okay,
what
so
we do here.
It's hard. Fair enough. Okay.
So, Kim, are there any other sectors out there in the market you're looking for, or are there factors that are kind of driving your process these days?
Well, we take a kind of weird approach where we say we are stock pickers and mirror the S&P 500 with our picks with respect to sector weightings. So putting that aside, that we're kind of sector neutral, I think it's really interesting. Tech is big, and I think you should stay concentrated in that. But I'd also look for some unloved areas, kind of like consumer discretionary. At the top of this segment, you pointed out most of the strategists think we're going to, go backwards from here. But if the consumer keeps spending, why not look at names where the consumer is spending and that they are gaining market share?
Like where, Kim?
Well, retailers are a big fascination of mine, and we're going to, at the end of this earnings season, hear a lot more from them. I don't really want to trot out any of the names because I have smaller names in that section.
Okay.
But yeah, I do like retailers, and I think they're very much unloved at this point, given, we're all looking for that pullback or softness to occur this year.
All right, Kim, thanks so much for joining us. Really appreciate it. Kim Forrest, founder and CIO of Bokeh Capital Partners, located in Pittsburgh, Pennsylvania. So good stuff there.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
You got the Dow up 200 points. I'm on 40,000 watch there. We're 38,800. So I like those nice round numbers. We eclipsed 5,000 a couple of days ago in the S&P, 16,000 on NASDAQ. So we like some round numbers there. Yeah, why not? But I know the pros do it and, do a little bit more analysis than that, than just round numbers.
But honestly, if you just bought like an ETF or NDX, you'd be fine.
Exactly. All right, let's check in with Jennifer Oppold. She is the founder and portfolio manager of Alpine Peaks Capital. She joins us via Zoom from New York. Jennifer, what do you make of some of these heights we're hitting here on these markets? I guess it really, started this latest leg back there in November, December last year, kind of continuing into this year. What do you make of these market and these levels?
Yeah. Hi, good morning, Paul and Alex, and thank you so much for having me. It is really interesting. We saw this strength. I think it was really signaled by the Fed signaling, especially in early December, that they were going to start cutting rates. They baked in about 3 rate cuts, as you guys know, for 2024, and a lot of commentators are expecting more. And we did see a lot of that optimism, I think, get priced into the market in December. And so it was interesting in early January to see some names pull back a little. We definitely saw some market volatility, which I think is healthy, by the way. It offers us all opportunity. Today, though, as we're starting to, it'll be interesting. Tomorrow we get the fresh inflation numbers. So that's probably the best indicator of what the Fed is thinking to do. But so far as you were just pointing out, companies have been putting up pretty good earnings as they posted for most of them their fourth quarter results, and so that's definitely positive. It's always interesting for people like myself to hear companies actually report their outlooks for 2024 and to get that guidance. I think there's a lot of speculation as to what companies will do, but it's great to hear it from the horse's mouth and actually get the outlook from these companies.
So Jennifer, we've seen the rally sort of broaden. I appreciate that the equal weighted index for the S&P hasn't had the breakout that the S&P has, but the Russell's up there, industrials, healthcare for the S&P we're doing really well as well. Do you buy the rally breadth as good or the rally breadth as bad?
Yeah, it's an interesting question where you have some real breakout strength continue in a handful of names. But I think the economy and certainly lower rates will be good broadly for the economy. And so it makes sense to me that we are seeing this more broadly. And that is something that I would expect to continue. Obviously, not universally. It does matter what's happening on a company specific level, and you do have winners and losers within that. But I think the environment should be supportive for the breadth of the rally, if you will.
So how much or how important is this Federal Reserve for you and your investment outlook here? I kind of feel like the market's really just trading on where the Fed is going. I'm not sure they're just paying as much attention perhaps to the earnings as we typically do. How do you view the Fed and its impact on the market?
Yeah, that's such a good point, and I agree with you. It's interesting. So we have a 5-year average holding period, and so we are taking that longer term view and thinking about our companies across business cycles rather than just what next quarter will look like. But I do think that a lot of people are, focused more on the Fed right now, and particularly getting excited about the prospects of perhaps accelerated rate cuts. We don't think that'll happen as quickly as some people do, but nonetheless, even if you take the 2 to 3 cuts that are kind of at the bottom end of the outlooks, that's still helpful for this coming year. And so it's interesting that we do see, as companies report earnings, we do see them revert more. I feel like can be a lot of momentum and excitement priced into names intra-quarter, but we do see them typically return to trading on their own individual outlooks as they report earnings. So that's always a particularly interesting moment of truth for us, if you will.
You have some cool companies that you look at. Rollins, if I said that right. Rollins.
Yeah. You did.
Pest Control Services, which is ticker ROL. Walk us through why you like this one.
Yeah, absolutely. So they are the leading independent pest control company in the United States. Their largest competitor, Terminix, was just bought out by a UK company called Rentokil last year. And it's really leading.
Love that. Okay.
Yeah. And it's a compelling time in the industry there's a few broader macro reasons, if you will. Global warming is supportive of pest populations. Demographically too, our generation and younger generations are more likely to hire somebody else to deal with pests rather than do it yourself, as the baby boomers tended to do. And so we're seeing, go ahead.
No, go ahead. Continue.
Okay, excellent. And so it's a good environment for the pests, if you will. And it's a time where Rentokil's always been a really strong competitor in the area. They have really powerful door-to-door sales, have been investing heavily in technology. They also have a very clean balance sheet, and that's enabled them to typically add between a third and half of their growth from acquisitions. And so they continue to roll up smaller pest control companies, share best practices with them over time, be able to really improve margins there. It's created a very positive dynamic. It's also making an interesting transition now from being a family-dominated company. The Rollins family, actually, they just sold off a portion of their stake, but they still own over a third of the company. To bringing in last year was the first year that a non-family member was appointed CEO. And so while the Rollins family has done a great job building the business, I think there is a really interesting switch to a little bit more of a bottom line focused perspective right now there.
We've had aviation when we talk about Boeing, and it's been in the news, not for the good reasons. You have a manufacturer of aviation parts, HEICO. HEI is a ticker. Tell us about that company and why you guys like it.
Yeah, absolutely. So they're a really interesting company. They make what are essentially generic aftermarket aviation parts. So it's almost akin to generic drugs if you think about pharmaceuticals. But in this case, so they take what's called an OEM part, or original equipment manufacturer, and they reverse engineer it to be made out of the same materials, to be able to meet the same stress tolerances, to last just as long and have similar quality. And then that's approved by the FAA. It's called Parts Manufacturing Authority, or PMA is the acronym used in the industry. And then by each individual airlines. And airlines like these parts because they typically sell for, starts at about 30% less than the OEM price, and that can widen out to as much as 70% over the year with volume discounts. And so it's a great way for airlines to save money. And HEICO's really the dominant player in this area. They just bought actually their largest competitor called Wencor. And it's a space they know really well. It's adding about 30% revenue to the company this year. And it's a very exciting time for them. Taking the recovery in air travel that's happened post-pandemic over the last couple of years. And then the market gains they've made as they can help airlines improve their own economics.
Jennifer, great stuff. We really appreciate you joining us. Jennifer Oppold, a founder and portfolio manager over at Alpine Peaks Capital. Quite interesting.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.